All right, of course, we continue to watch the Fed after inflation data in August came in higher than expected. Even with that PPI data today, there is still a lot of shifting expectations that has been sending the markets into the red and shifting expectations for further future rate hikes. Here to discuss all of this is Thomas Simons, Jefferies money market economist. Thomas, thank you for being here. So as you try to game out, we've been talking to a lot of different folks about what the Fed does now, not necessarily next week, but beyond that. I guess I want to back up for just a second, Thomas. Why are we expecting inflation to come down more and it's not happening at the rate that we expected or hoped?
So I think that expectations that inflation, I hate to use the word transitory because it's been kind of, demonized in the last 18 months. But, there is still this sort of long held view that inflation is not a sustainable thing that can be generated by the U.S. economy. And that really is sort of a memory of past cycles, specifically the post financial crisis cycle. We had this long period of time with extremely accommodative monetary policy, expansionary fiscal policy at times, and yet we had virtually no inflation over the course of a decade. So I think it was reasonable to assume that was going to continue. We pumped the economy full of stimulus, both monetary and fiscal, after COVID. Initially, there wasn't really that much inflation, but now as the economy has, had to sort of restart itself, and there's been a lot of supply constraints, specifically in labor at this point, it's been much stickier. And quite honestly, the labor market has held up very well. Wage growth has continued, and it's not as much of a supply story anymore. It's really demand driven, and that's much more difficult to contain once it's started to get sort of out of control.
There have been calls or anticipations for the unemployment rate, though, to tick higher, even if we are to see some type of soft landing constructed. But I mean, the odds of that, depends upon who you ask at this point. So where are you expecting the employment situation to trend towards, even as we've seen some of these larger job cuts that have taken place from companies announcing restructuring plans most recently?
Yeah, I see that there's more or less a mixed shift going on with jobs. You have certain companies that have announced, layoffs of various different sizes, but there are certainly plenty of others that are looking for more help. We still have 11 million job openings in the labor market that are still waiting to be filled. And most surveys you see, whether it's the ISM or the NFIB small business survey, they still show this really strong demand for labor that they're going to continue to hire. So if we think about this in terms of just how much slack there is in the labor force, for instance, how many people left the labor force at the beginning of the pandemic and have yet to return, there's really only a few more months worth of hiring at the current pace before you get to this sort of frictional point where there just isn't any more available labor. So I do think that we're going to continue to sort of see the unemployment rate trend sideways for a couple of months. Once you get past that, it could actually trend lower, assuming that growth doesn't fall off the table, completely.
Well, let's talk about that potential, right? Because you say in your note reacting to CPI that the terminal rate probably isn't going to be 4%, probably isn't going to be 4.25%. It could be 4.5% or even higher than that. What kind of damage, as the Fed is trying to beat inflation with a mallet, what kind of damage is that going to do to the U.S. economy?
Well, that's a difficult question to answer. How much damage has been done by high inflation over the last 18 months? Good point. It's really a trade-off, right? And the continued inflation at this pace would be a disaster for the economy, specifically because it hurts lower income earners so much more than higher income earners, right? And there's really very little that can be done to support those folks if inflation is going to persist at that level indefinitely. So really, in order to establish a balance in the economy, we really need to take down demand pretty significantly in order to get inflation closer to 2%. And that's going to require a very restrictive monetary policy at this point. I think that if we looked at where the economy was trending over the early part of the summer and even sort of the labor market and even in the realized inflation data, there was some reason for optimism that, we had seen inflation peak. It's going to roll over. As the Fed gets sort of marginally into restrictive territory, these things will continue with that momentum. But I do think that within the last month, and this CPI data report yesterday included, showed that a lot of the things that we saw slowing down over the summer have not continued to slow down into the early part of the fall here. They actually show some significant signs of reaccelerating. I mean, specific to some of the elements of the CPI report that were mentioned just earlier, home furnishings. The data that had been moribund for years on that specific category. And, just as we see gas prices come off from the highs in June and July, it looks like you're starting to see this shift as, consumers are immediately turning that savings around and spending it on other things. And retailers are seeing that they have more pricing power than they thought. In order to get that down, we're really going to need to see interest rates rise very significantly. And the Fed can't afford to take their foot off the accelerator at this point.
But is it that they're spending on those other things? And I ask that question with the mindset of, is it that they're actually spending cash that they're saving from the gas prices coming down on other things? Or are they just spending on other things and it's showing up as spending, but it's really kind of that credit spending? And what type of kind of scenario does that create in this broader economic equation?
Yeah, we've seen some mixed signals on that. Recent consumer credit data has been some of the biggest increases we've seen on a monthly basis in several years, if not, I believe one recently was actually a record high. But at the same time, if we look at household balance sheets, there's still a massive amount of accumulated savings amongst households from the early days of the pandemic that is still sitting there ready to be spent. We've tried to estimate this in various different ways, but can kind of quickly think of this as last fall, households had roughly $2.5 trillion collectively in excess savings above the trend rate from 2019. Only about 400 billion of that has been spent, and obviously that's a lot of money. But that still leaves roughly 2.1 trillion of this accumulated savings that's still on balance sheets that's there to continue to fuel spending. Again, this is a thing where there's a very significant diversity amongst different households in the income spectrum. Obviously, a lot of this is held by high income earners, but high income earners also tend to be some of the bigger spenders in the economy as well. So when we're thinking of this in aggregate, there's still a lot of power there.
Thomas Hyman's Jefferies, a money market economist, joining us. Thanks so much for the time and the breakdown, the insights. Appreciate it.